Just want to remind everyone there's a live cast at 1:30 Eastern Time on Wednesday. Make sure you join us. It'll be a 1-hour show. It will give me the opportunity to answer your questions and actually go into more depth than I can on these videos I do every day. Well, today is going to be all about the Fed and a bit of history about the Fed. Every Fed chairman has had a crisis to deal with. Paul Volcker had hyperinflation and ran rates to 20%. Alan Greenspan had the crash of 87 and 89 to deal with. Ben Bernanke had the housing crisis and the banking crisis to deal with. The only one that has escaped so far has been Janet Yellen. She had no major crises. Now we come to Jerome Powell. What's going on right now will be the single largest challenge of the central banking system that we've ever seen since its history. This is the biggest crisis there ever has been, and decisions have already been made about how to handle it. We'll now have to watch it unfold. I think it's important to understand a little bit of history of what the Fed's done in the past in these major crises. If we look back in history and compare some previous crises and what happened and how the Fed handled them, I think it gives us some contrast to what we're likely to see right now. In 1997, the Asian financial crisis, as well as in the taper tantrum in 2013, the central banks of the planet were defending their currencies and they raised rates to keep the currency base stable. This time, like in 2008, it is about debt, and it's about dislocation of capital as well that I've been talking to you about. This is important to understand because the debt crisis that's being created through the stimulus packages, as well as the Feds supporting the market, and the size and magnitude of the monies that have been spent are absolutely out of control. With the Fed going into corporate markets, municipal markets, and just about any market with the exception of equities, and people keep asking, will they buy equities? I don't think they will. It is not in the mandate of the Fed to buy municipals or corporate bonds. They've already violated their mandate. So anything is possible. This time, because of the size of the debt, they have to make sure the government market and other markets remain liquid and stable, and they've been doing a good job with that. You may recall several weeks ago, I warned about the issues that were likely to happen in the bond market if certain things weren't fixed. So far, so good. They've plugged a lot of holes, and the MBS market, the mortgage-backed securities, are stable. CMBS are still having their issues, and municipal bonds have stabilized. Now, the Fed's job is to keep this liquidity in place. The Fed has also been providing dollar swap lines, keeping stability in the flow of dollars around the world in the payment systems. I mentioned the currency debasement issue last evening. This is being mitigated to a point because of the actions of the dollar swaps and the actions of buying these bond assets for the moment. The reality is that the Fed is now the central bank of the world. The risk here is that they fail at their job and the entire world economy implodes. I've discussed with you the dislocation of capital, the loss of income that is affecting virtually every sector of the economy. But at the moment, market participants continue to buy into the Fed's pumping of dollars into the market. As I've discussed many times in the past, the markets are being driven by speculators, and the flow into the markets don't necessarily tell us what's going to be going on with the economy. Oftentimes, the markets and the economy are not the same thing. This certainly isn't the first time that's the case. Overnight, we're seeing a lot of strength ahead of the meeting with futures up over 1%. I'll go through this in the technical section here in a few minutes on what I believe is happening. But the euphoria that the Fed is creating right now is substantial, but I still have fears of a letdown after the meeting tomorrow. Anything that Chairman Powell says that market participants aren't necessarily happy with may cause a trigger for some selling. This is the point in time where the markets could hit an exhaustion point and start to see some profit taking. Let's take a look at the technicals and see what we can figure out for the balance of the week, and especially the next 2 days, which are going to be critical for the pattern we've been watching unfold for the past 6 weeks. We're going to begin by looking at a very short-term chart. This is the 5-minute graph of the futures, looking at the end of yesterday and what's unfolded so far tonight. We traded just above the 0.76 retracement of yesterday's decline, and now we're starting to see some pressure come in. But the opening in the morning is going to be very interesting. Usually the Londoners will show up and start buying the market up. This has been the pattern for the past several days. Tonight they were sellers, but this pattern is interesting in that it hit that retracement, and we're likely to see further deterioration coming into the U.S. Open. My expectation is it will open stronger, but markets are going to be somewhat hesitant as we go through the session. This is the daily chart of the futures. It also shows an interesting pattern. We're trading within an inside bar at the moment. We're seeing a slight uptick in the ppm 1, which is at a plus 0.42, which is very positive, suggesting major support at 28.22. ppm 2 is still at plus 49. ppm 3 is flattening out, which tells you that that is the major support at 26.70. So this pattern continues to emerge, and it's possible we could see a move as high as the 30.34 level, which would be a full 0.76 extension. Wednesday's market's going to be very critical to the pattern of the continuation. I discussed last night that I thought there was a possible reversal pattern. We did get a reversal on the cash market. Let me show you that. See, it opened sharply higher yesterday and declined throughout the session, closing near the lows of the session. If we do not take out the high of 29.21 on Wednesday and we close lower, this will confirm the reversal and suggest a decline toward the 28.20 with probabilities of declining toward 27.31. If we do take out the high, then there's likely to be a continuation pattern going to what I was just talking to in the futures up to around the 30.24 level. Our short-term models continue to be long in this market. We're not getting any sell signals here. So there's a likelihood of this thing continuing on. I want to remind everybody to join the livecast. We'll be able to watch a real-time response to the Fed's release of their statement. I look forward to answering your questions and going into much more depth at tomorrow's live stream.